Now, one thing you want to be aware of when trading an indicator method such as this Keltner Channel trading strategy is that, like all indicators, there's a lag time. Indicators are derivatives of price, meaning that the results that you see via an indicator will come via a calculation using the price that you see on your chart. Price first, the indicator second. Now, before we get into the strategy that you can use with the Keltner Channel indicator, let's cover why a channel can be useful for really any trading strategy. A channel measures extremes. It's the buying and the selling by humans and computers, although the trading programs, they're programmed by humans, that will move price. As humans, we are susceptible to emotions and beliefs, and the emotions are even more vulnerable when money's on the line. Channels, and this includes the Bollinger Bands and the moving average envelopes, they're theoretically designed to surround the general price action of the charted instrument. The keywords are the general price action, because anything seen outside of the general movement of price can be considered an extreme movement. Now, one way to envision this general movement is consider that the price is traveling without an extreme bullish or bearish bias. While there may be an overall bias in one direction, there is nothing out of the ordinary with the movement of price. But there are times when a that's different moment takes place, and the price will make a move in one direction or the other. Now, this is the time you want to be on alert for potential trading opportunities because it's clear that the volatility has changed. Now, you use the word potential because you don't want to take a trade just based on an indicator alone. There are other things to consider, but we can use the Keltner Channel bands that surround the price and the channel's moving average as an alert for possible opportunity. Now, the bands do not act as a physical barrier to price, just as a moving average does not magically support the price. They are a measure of volatility in the case of the bands and consensus when we refer to the moving average. Keeping that truth in mind, you can see how important it is to not just push the buttons because the price has found itself in those locations. So the moving average consensus, the Keltner Channel, it's plotted with two outer bands, and through the middle is a 20-period exponential moving average in EMA. Using the moving average as an area of general agreement in price, we can see that when price moves away from it, that one side is favored over the other. The further price moves away, the more we can expect a snap back in the price. The moving average can also act as the landing zone after the price makes a snap back. And when I say zone, I mean we don't expect price to land directly on the average. That's why we don't simply execute trades when price is supporting or resisting in the area of a moving average. Now, like most indicators, there are inputs that you can change, and that in itself can offer up a whole set of problems. Now, there are several settings that we can change with the Keltner Channel depending on your platform. Number one, the moving average length. This will determine the lag time of the channel. Number two, the average true range, the ATR. Number three, the band multiplier, which uses the ATR reading. The moving average type, EMA, SMA. The ATR type, EMA, SMA. The band multiplier, it's very important because that's going to determine how tight the outer and the lower bands are to the price. If the bands are tight, you'll get a lot of excursions to the bands and beyond. And this may be suitable for those scalping with the channel, but not suitable for those looking for longer-term plays in their instrument. Day trading is also a viable option with the Keltner Channel, and you can tweak the band multiplier to suit your trading needs. Now, the Keltner Channel versus the Bollinger Bands. Now there are those that often confuse the Bollinger Bands and the Keltner Channel, but they act differently in terms of reaction to price. The big difference is the Bollinger Band is calculated using a standard deviation, while the Keltner uses ATR. You can visually see how the Bollinger Band reacts differently with sudden price shocks. Now, some traders actually use the Bollinger Bands and the Keltner Channels together to show a Bollinger squeeze. When the Bollinger is inside the Keltner, the squeeze is on, and when in a trade setup, the movement of the bands outside of the channel is a trigger. This would indicate that the price is potentially about to go on a run. Now, whether you're going to use a channel or the Bollinger Band indicator for this, it's not the point. You can use either because it's just the concepts that we're looking at. So the channel trading plan. The original Keltner used a 10 period for the moving average, but it caused traders to be whipsawed around far too much. Over time, the popular setting became a 20 period EMA, a 20 period ATR, and a 2.25 multiple. You can, of course, test various settings, but in the end, we are simply looking for price engaging with either side of the channel. Now, pullback trading. The trading pullbacks, it's best done in a market that's exhibited a strong push in a direction. Now, this is based on swing analysis, where you want to see conviction in a market swing that indicates another move in the same direction. Using the Keltner Channel, we can use a travel outside the bands as an indication that there was conviction in the swing. If we are trading in a downtrend, you want to see price travel to the bottom channel and plot outside of the channel. Even a shadow plot is sufficient if you are a more aggressive trader. Remember, an excursion outside of the channel indicates an extreme from what was considered normal price action. When price is at the channel, that is an alert to look for a pullback in the price to an area around the 20-period EMA. This chart here shows a downtrending market in play. Highlighted by the orange color, you can see that price has traveled outside of the channel. This is the first sign that we may have a trade if the pullback fits other criteria. In certain charting packages, you can set an alert that will signal you if, when, prices hit the channel, and some of you may find that pretty useful. Now, not all excursions equal the pullback into the zone around the moving average, and you can see that at times price traveled along the channel. Now, this issue will be covered in a later trading tips segment. We now have 3 definite pullbacks that met our criteria. Number 1, excursion outside of the channel. Number 2, a pullback to the area of the 20 EMA. 3, an obvious trending market. Now, Confluence and trade triggers. Our potential trade is now being set up, but we still don't simply enter when price touches the 20 EMA. We would like to see price pulling back not only to the midline, but also to a price structure or exhibiting a topping pattern. This is called Confluence, and it can actually increase the probability of your trade getting some action. Now, we need a trigger to get into the trade, and there are many tools that you can use. Momentum indicators are a popular method, as well as the very basic trend line. This chart is a factor 4 less than the previous chart. By using a smaller time frame to get into the trade, you may be able to get a better position sizing as you position yourself higher in the curve to the downside, in this example. Now, the black dotted lines on this chart are boxing off structures of possible resistance that coincide with the pullback to the midline. Let's call these potential resistance zones, because when price is pulling back, we do not know with 100% certainty if price will stop at these areas, but it potentially could. These potential zones of trading opportunity that includes the structure are from the trading chart, and I encourage you not to use the trigger chart to find the structure. The trigger chart is only used for exactly what the name implies, trigger. Now, before continuing, the area mark 3 may have some questions. It's a sloppy, complex pullback because the second leg did pierce the bottom of the first before reversing from what may be considered a double bottom. Now, where this gets interesting is the second leg matches in distance the first leg of the move. This is called symmetry, and many traders will utilize this as a standalone trading system. Price also exhibits a topping pattern, a double top, and you can see from this chart that a confluence of factors were in play when price broke solidly to the downside. Now, I'm using standard trend lines to show the counter trend move in price, which brings us to our setup zone. You may use a standard break in the trend line for your trade entry. Stop placements could go either above the turn or above the zone that is acted as resistance. Now, trade targets. We're going to use a setup chart for targets, and like trade entries, you do have a few options. Some traders like to target opposing structural, while others would like a more objective means to find profit targets. I've spoken about Fibonacci many times over the years, and I've shown examples for my own trading. Fibonacci was my original method of trading when I first started, and have since refined things since the early days, though. Now, the fact that we're trading pullbacks makes it easy to find our targets with Fibonacci in a way that is completely objective. We're going to take the move into the extreme of our pullback and project forward in time to a potential price target. The diagram on the chart shows that A is the anchor point, and you pull the Fibonacci retracement tool to B. You project your targets at C. Now, here are the numbers that I personally use and I'll use for this example. Note that the 200 is omitted, but I do use it for targeting after a range. 1. I use the bottom of the structure range for the entry price. Number 2. I use 0.786 as the stop price once price breached the low of the swing leading to the extreme. Number 3, whatever target price hit just prior to breaching 786 is a full exit in price. You can see the total pips for each trade in green for a combined total of 245 pips before spread costs. These targets are shown on the trigger chart for the detail. Now this Keltner Channel trading system, it's not complicated, but do not be misled by the simplicity. You still have to put in the work in determining the overall trend direction, when counter trend trading is appropriate, extent of excursion, plus the very important account management risk profiles. Now that's just to name a few variables. There are also other trading opportunities that Keltner Channel trading provides, and I'll cover some of those in a later post. Now a lot of work goes into designing a full trading plan, including back testing and forward testing. Take a seat in a free NetPicks trading webinar where you can see how a properly designed and tested trading system can increase your trading success, and you can sign up right here.